Carol, we are into the holiday shopping season. There's a lot of questions about the economy, a lot of questions about the consumer. You've been doing this a while and watching these things. How do you kind of measure this holiday season with others?
It's tough to compare it directly to last year, given the changes in retailers brought inventories in substantially earlier this year. Sales have been happening, basically Black Friday sales since October. We've seen that given a lot of those inventories. And it's one of the reasons why we saw a lot of goods on floors back in August and September. We saw a lot of holiday goods out already. But consumers overall seem to be doing okay, but that shift in spending towards services over goods really seems to have taken hold, and inflation is clearly on everybody's mind too. I think there's some level of almost revenge spending where people are trying to spend on others, they're trying to engage in trips and experiences and things like that. But we'll see how that carries over into January when those credit card bills start hitting, because we know a lot of people that have half their savings moving into credit cards. And so when credit cards hit, and most likely higher energy bills than last year as well, it could be a softer early start to the year, at least psychologically.
I'd heard, up 2% or so in terms of sales for that Black Friday and the holiday weekend, more than $9 billion. But you're still talking about with numbers that don't keep up with the pace of inflation.
Exactly. You've got that inflation impact in there. And then you've also got the shift in goods. And we don't know how profitable that couple of percent increase is for the retailers, because there definitely were a lot more sales going this weekend than there were last year for certain, but in the last few years. So washing it all out, it'll be the end of January, beginning of February before we truly see the full impact for the retail sector.
Ross, you say you wouldn't be surprised if we retest the lows before the end of the year. That's a pretty big drop.
It is, but I think, the basic fundamentals of the market, are just not quite in line yet, right? You have a multiple on the S&P 500 that is attractive, but certainly not as low as we've gone in past bear market bottoms. And then you have earnings estimates coming in, particularly for 2023, pretty rapidly as analysts revise lower. So if you just put the two things together, if we got a bit of a valuation compression, if we got rates a little bit higher again, if the Fed came out hawkish, and then you continue to see pressure on the earnings side as margins get squeezed, as maybe there's less of a consumer spending impulse. I think it's certainly possible. I think the Fed will view their job as not quite done and will jawbone hawkish again, kind of into year end, even if the statement lays out a path towards dovish policy. But yeah, this is, these bear market rallies are super common in these longer bear markets. We're used to, V-shaped rallies of the last couple of years. But the reality is, look at 2000, 2002 or 2007, 2009. You get several really, really strong bear market rallies until you reach ultimately the bottom. There's some pieces of data that would suggest we've gotten there. And then there's others that would suggest we might have more room to go. So would I be surprised? No. Is it our base case? Either, probably not. But I think that investors need to be, preparing themselves that this thing might not be quite over yet.